Hello, everyone, and welcome to another video, another financial market update from this last week. I apologize for not putting out any videos these last few weeks. I was actually out of town the last 2 weeks in Europe, just a fun little vacation before grad school starts. And a lot happened these last few weeks in the financial markets, especially this last week. So I'm really excited to report everything that happened. So this last week from August 7th to 13th. So first of all, here's just a snapshot of all of the performance of the stock markets around the world this last week, all of which were in the green. In the USA, we have the NASDAQ Composite, which was up a little over 1% at 1.28%. The S&P 500, which grew about 3%, and the Dow Jones, which grew also about 3%. And the reason that the US stock market has performed so well this last week was due to multiple reports showing decreased inflation, which I'll talk about later, as well as strong consumer spending reports, earnings reports, and optimistic earnings guidance going forward. At this point, most companies have reported their earnings during this earnings season for this past quarter, and most have absolutely crushed their earnings and put out really optimistic guidance going forward, which has fueled a strong economic rally here in the markets. Elsewhere in the world, in the UK, their main index grew about 1% due to strong earnings reports and renewed economic optimism. And then in Asia, we have China up about 1.8%, and Japan, which grew almost 3% as well. And this is due to strong earnings reports once again, particularly in technology companies, which both those countries, China and Japan, really benefit from, as well as strong optimistic guidance going forward as well. In the world of cryptocurrency and commodities, we have Bitcoin, which was up about 6.36%, and Ethereum, which was up over 17% just in the last 7 days. This is actually I believe the third week in a row that both Bitcoin and Ethereum have been in the green. In just this last month alone, Ethereum has just about doubled. A few weeks ago, we saw it grow about 25%, and then 20%, and now 17%, all just in a matter of a week each. And then in the world of commodities, we have gold, which has grown 1.5% this last week, silver about 0.5%, and oil, which went up about 4%. This is the first time in a while that oil has increased, which isn't the best sign because rising oil prices means rising gas prices. However, it's still significantly below where it was even just last month. So some different factors that are affecting the market right now and causing these changes are one, peaking inflation. So as I mentioned, there was a lot of different reports that came out this last week about inflation, mainly the CPI and the PPI. And these have both showed that inflation, at least on a month-to-month basis, has been declining, which suggests that we may have passed the peak of inflation, which has excited the stock market and all the investors. Um, in addition to this, there's the investor optimism, which has been surging recently. So there's the VIX, which I talk about a lot, which is the volatility index. It dropped another 10.16%. This is actually the ninth consecutive week of declines on the VIX. And this signifies that investors are becoming really confident in the markets, not only in the short term, but in the long term. This is the longest decrease in this index, so the longest decrease in fear or volatility in a very long time, since the last real stock market recovery post-COVID. And then lastly, as I mentioned, there's been earnings report and guidance, which has mainly been positive. Almost every major company has crushed their earnings estimates this last quarter, and most companies have issued strong forward-looking guidance, which most investors pay really close attention to. And most of these companies, in their earnings discussions, have said that they've seen very limited impact of lasting recession or inflationary pressures. Mainly big tech companies actually reported really good earnings. All big tech companies, besides Netflix, actually reported very good earnings. And even then, Netflix, in some ways, did exceed their earnings. And as big tech continues to exceed their earnings, that'll just continue to fuel the stock market rally as big tech very heavily drags the market one way or the other. Some notable events from this past week. So as we saw on the first slide, every major international index ended in the green this week. And then all three indexes, so the NASDAQ, S&P, and the Dow Jones here in the United States, have ended in the green for the last 4 weeks. So this was the fourth consecutive week of gains, which is actually the longest bull run since the COVID stock market rally. And then, as mentioned, here's the two inflationary readings, the CPI and the PPI. So first of all, we had the report for July's CPI, or Consumer Price Index. And this shows inflation on part of the consumer. And this decreased. Back in June, the CPI was 9.1% in growth, but in July was only 8.5%, which is showing that inflation is decreasing on part of the consumer. And then the PPI, the Producer Price Index, also tracks inflation, but on part of the producer rather than a consumer. And this actually had a severe drop. So the PPI back in June was 11.3%, whereas it was only 9.8% here in July. So this was a very significant drop and shows that inflation has most likely peaked not only for the consumer, but also the producer, which has really fueled the stock market rally. In addition to this, we had the July Consumer Sentiment Index come out, which was much higher than anticipated and is showing that consumers are really confident um, in today's economic conditions. And then lastly, also as mentioned, almost all major US companies beat their earnings reports and gave really strong guidance going forward, which has definitely fueled the stock market, um, which has brought us into a fourth week of gains. And then some things to look for this week. So going off the VIX, the fear index, whether that declines again, as mentioned, it's declined for 9 weeks. So we can see if it will decline a 10th consecutive week, showing that this decrease in fear really is a long-term trend. And then we also need to pay attention to whether the remainder of earnings report beat expectations and provide positive future guidance. Most companies have reported their earnings, but there still are a few left in the coming weeks. Another important thing to pay attention to is any further commentary from the Federal Reserve in regards to inflation. Um, they don't meet in August, meaning that there won't be a rate hike this month. The next potential rate hike won't be until September. However, it'll be interesting to see because we had two reports, the CPI and the PPI, this last week, which were both positive. It'll be interesting to see whether they do continue to raise their interest rates very aggressively. The reason that they've raised them aggressively in the past was to combat inflation. And then we're seeing from these reports that it's been working and that inflation is coming down. So I wouldn't be surprised if going forward the rate hikes aren't as aggressive or maybe not even have a rate hike going forward. But we'll see come September. And then the only real important economic report this week is just the jobless claims report on Thursday, which will show the state of the labor market here in the United States. That was weird. And then just the last thing here, just some weekly commentary. Like I said, each week I just want to hit on a different investment subject that I feel like is very important and just explain it. So this week I wanted to talk about DRIP, which stands for Dividend Reinvestment Plan. This is one of my favorite things to talk about when it comes to investing because it is so important, especially on long-term investing, which I am doing. I love long-term investing because I'm young and have a lot of time ahead of me. It's important to um, find ways such as the DRIP to really grow our portfolio in the long term. So what DRIP is, this is the process of just reinvesting your dividends into your portfolio to purchase more assets over time. So essentially, when you own a stock, some companies, most companies pay a dividend. And if you own a stock, that company will pay you a dividend simply for owning shares. And then using DRIP, you would take that dividend, that cash they gave you, and purchase even more shares in the company. And this essentially means that rather than receiving cash as a dividend, you're essentially receiving stock as a dividend because you're turning this cash instantly into stock. And this is beneficial for long-term investing because a cash dividend sitting in your bank account provides no real value besides liquidity, whereas a reinvested dividend is now growing in two ways. It is now stock, so it's growing in capital appreciation, but it's also receiving future dividends. So you are essentially receiving dividends on top of your dividends. So this is a snowball effect. As your dividends are being reinvested, they grow, they receive dividends, which will be reinvested, which will grow and receive dividends on top of that. And it's just this snowball effect where your investment is continuing to grow in so many different ways. Um, so right here, I found a calculator online. This is just a drip calculator, and it shows um, the value of your portfolio over time if you do reinvest your dividends versus not reinvesting your dividends. So just to explain here, I made some assumptions when I was going through the calculator. The first assumption is that the dividend rate is 3%, which is in line with the market average, and that the company grows at a rate of 7% a year, which is also in line with market average, kind of even on the lower end. Um, and then since I'm really young and I'm doing this for the long term, I decided to set a long-term horizon. So I put 50 years holding this investment. Um, so as we can see here, after those 50 years, if you did not reinvest your dividends, so you held this investment all 50 years, but you didn't use DRIP, you would end with $416,000, 416,528. However, if you held this exact same investment for the exact same amount of time, 50 years, but you did reinvest your dividends, you would end with $1,281,215, which is just about 3 times the amount when you didn't reuse DRIP. Um, and this is just really important because it shows the power of the snowball effect of drip. When you reinvest your dividends, you are growing exponentially over time. Because, like I said, you're now receiving dividends on top of your dividends. And this really is one of my favorite subjects when it comes to investing because it's arguably one of the most important parts of investing. Um, as you continue to use DRIP and as you continue to dollar cost average your dividends into your portfolio, you'll see incredible growth in the long term, and you could potentially double or even triple your investment as we see here on this calculator. But that's all I had today. Thank you so much for listening. It was definitely a very eventful week, and I'm sure this next week will be very eventful as well. So I'll be talking to you all next week. Yeah, see you then.